Welcome back to the Armchair Trader podcast. And this morning we are talking about precious metals. We're talking about investing in gold and silver. And on the show today we have Nitesh Shah, who is head of commodities research at WisdomTree, and he will be joining us to talk a little bit more about these important markets, particularly important now as we've seen some upside movement in both gold and silver prices in recent weeks. Welcome to the show, Nitesh.
Thank you very much. Thanks for having me.
So just to get started, WisdomTree, for those people who are not familiar with the company, can you give us a quick summary of WisdomTree and what you guys do?
Yeah, so WisdomTree, we're an international provider of exchange traded products. And here in Europe, our product suite in exchange traded products is very much, we have a large concentration of commodity-backed products. We created the world's first commodity exchange traded products here in Europe, and we've been growing that suite since. So we've got a product base in Europe of just under 30 billion of assets under management, and of that, close to 20 billion, or more than 20 billion of that, are in commodities, and the largest proportion of that is actually in precious metals as well. So we follow everything that drives the commodity markets in quite some detail.
Great. So you know your stuff when it comes to talking about gold and silver then?
That's right. We do have a strong client following in both gold and silver. We also have platinum and palladium products as well. So yeah, we do cover the full suite.
So to get started, precious metals, gold and silver, if you look back over the history of financial markets, these are assets that investors like to buy when we see turbulence, political risk, inflation. We're also in a much higher interest rate environment than we have been for quite a long time. For many investors who've been in the market for only a few years, this is starting to look like a much more different environment than they may have been used to, and they may not actually have exposure at the moment to gold and silver. What is it about precious metals investments that make investors attracted to them during periods like this, and therefore drive the price up? Why do people like to buy them when there's high inflation, and how do they protect your portfolio?
Both gold and silver tend to have quite special properties, and gold in particular is quite different to most commodities. The typical commodity you'd expect supply and demand balances to be really the thing that drives their prices. If you take um, copper, for example, you'd expect the price of copper to be really driven by how much demand there is for copper versus how much supply is coming out of the mines and produced by the refineries. When it comes to gold, it operates almost like a pseudo currency. The balance of supply and demand of the physical uh, don't matter so much for price, um, but it tends to be a big bellwether for economic conditions. And gold is quite typically a defensive asset class in the sense that when you have signs of the economy cooling, or you have threats of financial instability or even geopolitical instability, gold tends to perform really strongly. But that's you know that's not the full story. Gold actually performs also well during times of economic strength as well. In times of economic strength, you very often have a lot of inflation being created. It's a byproduct of a hot economy, and gold tends to perform well then. And in that way, gold is almost a unique asset class. It tends to perform well at both extremes in good and bad economic times. Um, and no other asset class we can see does that. And therefore, when you add gold to a portfolio, because of its unique behavioral traits, it tends to act as one of the best diversifiers because nothing else in your portfolio behaves that way. And if there's only one free lunch in the investing world, and that is of diversification, and diversification is enhanced when you have low correlations. And gold, with its slightly weird behavioral characteristics, provides that element of diversification that no other asset class can. So, looking at that sort of inflation aspect, um, yes, we've had inflation uh, at sort of multi-decade highs in the recent years, and that has come as a result of the response to the COVID pandemic, with many central banks throwing um huge amounts of monetary stimulus, but also fiscal stimulus in that sort of post-COVID period. On top of that, we've had huge supply shocks. Last year, we had the Ukraine war as one big example of a supply shock, where Russia, as a one of the largest providers of energy resources, both in terms of oil and natural gas, being almost shut off from many of the big developed world nations in terms of imports. So huge both demand and supply side shocks driving inflation higher. People often ask, well, why didn't gold do a lot better last year? We had inflation at multi-decade highs, yet last year gold prices only were basically flat, 0.4% up. Um, it's because gold was facing major headwinds from other areas. I I mentioned that the central banks were stimulating through monetary growth in prior years, but last year they turned course and started withdrawing a lot of that monetary stimulus. Now, one thing we know about monetary stimulus is that there's huge lags. So while the stimulus came in place in the post 2020 period, that was driving inflation much higher last year. When the monetary stimulus was being withdrawn, was now starting to face the impact of that monetary withdrawal with cooling inflation. But last year, inflation was red hot, but bond yields shot up, and the dollar appreciated like crazy because the Federal Reserve in the US was um, putting its foot on the brakes a lot harder than other central banks at that point in time. So, two headwinds for gold: dollar appreciation, a spike in bond yields that was set against that inflationary backdrop. Net net, gold came out flat. But you have to put all these things together to understand that. Now, when we come into sort of 2023, what we've seen is that although the inflation picture has been cooling, we've seen that shock to the bond market fall away. Dollar has stabilized somewhat compared to last year. Um, and that's allowed gold prices to rise. And a few weeks ago, we started seeing gold prices head above that 2000 psychological, level. It slipped a little bit below that right now, but that's mainly as a result of bond headwinds and dollar headwinds falling away. And indeed, on top of that, you've seen investor sentiment towards gold actually pick up, as well as we're seeing increasing risk of um, recession pick up as well. And that's one of the reasons why a lot of investors have gone towards the safe haven asset of gold.
Do you think that there's any truth to these rumors I've been hearing about some central banks and state-owned entities also buying gold? Because I know some precious metal analysts have been saying that also is something that's changed really since the start of the year. Although I think some of that central bank buying may have been going on in Q4, but that again is something that's difficult to really properly establish because the gold market is not that transparent.
Yeah, I think you touched on several key points there. So central bank buying of gold was extremely strong even last year, 2022, where we established we had relatively weak gold price behavior. Uh, in 2022, central bank buying of gold was at an all-time high. So the data that the World Gold Council has put goes back to the mid 1960s. last year was the highest in nominal terms. And we saw very strong buying from countries like Turkey, um, China, which hadn't reported any gold purchases since 2019, started coming back in. And as of last month, Russia restated actually its purchases from last year. Last year they weren't reporting any purchases, but now they've actually gone back and reported what purchases they made. And that was, we thought, was a big missing part, because um, Russian refiners from March of last year were actually taken out the international markets because of the war. They were sanctioned. So the only uh, buyer of or only sizable buyer of Russian gold we expected was the central bank, and they weren't reporting anything. Now we know that they've actually been purchasing. Coming into this year in 2023, central banks and monetary authorities look like they're keeping up with the pace that they set last year. We've been seeing very strong gold buying so far in at least the first quarter of this year, and you've seen, countries which haven't been making any large purchases recently coming back into the market. So we saw the Monetary Authority of Singapore, for example, make some quite large gold purchases, and in doing so, they almost increased their gold holdings by more than 40%. So it's not just a what we were assuming as a developing world central bank phenomenon, is even going into the developed world. Now, there's been a lot of desire by central banks to diversify their currency base. And I think what happened last year spooked them. When sanctions were placed against Russia, a lot of central banks became quite spooked, because the dollar can be somewhat weaponized and turned as an instrument to punish the so-called bad actors, and therefore many developing world central banks that looked at their FX holdings and said, well, we could do with less dollar and probably a bit more something else, but the euro, the yen, other fiat currencies are all subject to the same risk, right? Because it's the G7 countries that are placing these sanctions on countries, and indeed, it's a trend that had already been existing before. That when you um, have FX holdings of other fiat currencies, you're essentially importing in monetary policy from other countries. And a lot of countries seek to minimize that risk. And therefore, gold, the pseudo currency that's not got any links to any of the central bank, is free from currency debasement or the risk of being subject to sanctions. So that's one of the reasons why the central banks had come into in larger force. Now, when it comes to impact on price, my modeling work has generally shown that central bank buying of gold doesn't really impact price that much. Mainly because you only find out that central banks had bought this gold many, many months after they made the purchases. For example, the Russian example, we only find out today, what purchases Russia had made, during the course of last year. Indeed, even China's purchases that they've been reporting since November of 2022, it's more likely they've been purchasing throughout the course of the year, but they would just start the reporting in later on in the year. So the actual purchases we don't actually believe impact price that much. And you're right. The lack of transparency there probably means that its impact on price is probably somewhat muted. But it's an interesting phenomenon to observe, because it indicates, by looking at the rationale for their purchases, you can get some sort of an indication of geopolitical risks and financial risks that are prevalent in the market, that central banks may be changing their behavior on the back of.
And you guys are managers of exchange traded funds. Obviously, gold has been around for a long time, a lot longer than than ETFs have. Um, Investors have bought gold through a number of different avenues traditionally, and I just wondered if you could shed some light on how the ETF structure stacks up against some of those other avenues, like buying physical bullion or buying gold futures in the market.
Yeah, you're right. Gold has been in an asset class that's been around for millennia, and ETFs didn't exist, in pre-biblical times. Sorry. Um, so you know, physical gold is obviously probably one of the most obvious ways of accessing the gold markets. Now, when it comes to physical gold, the institutional markets tend to invest in large bars, 400-ounce bars, in the typically in the London Bullion Metal Markets Association kind of governed region, which defines the quality of the bullion, not just in a physical properties, but also the manner in which it comes to being as well. So, there are responsible sourcing criteria that LBMA refiners are subject to. That's the physical market, but obviously there are, when you get to sort of retail markets, there are often smaller bullion bars, kilo bars. Even some people consider buying pieces of jewelry a type of investment in the retail world. Um, there's also investments that you can, ways of accessing gold through the futures markets. So investing in contracts for delivery of gold at a future date future point in time. Um, Now, these futures contracts that they trade on exchange, you don't have to take delivery of the of the gold. You can keep rolling these contracts. Now, as with every futures market, um, there is a curve structure to consider. So gold for delivery several months into the future tends to be priced at a higher level than gold for almost immediate delivery, and that reflects a couple of things: one, storage cost, but two, prevailing interest rates as well. Typically, that curve structure means that when you're investing in gold for delivery in a couple of months' time, um, that futures price, as time goes on, the price of that contract converges towards a spot, and that acts as a little bit of a drag on price performance. um, so that's one thing to consider. But on the flip side, with investing in futures markets, you get a lot of capital efficiency because you can invest on margin there. Now, ETFs, or exchange traded products, can either track physical gold or it can track a rolling futures strategy. And we offer products that go to both markets. But the lion's share of investor demand is for products that track the physical, um, and there's several reasons for that. One is because of that issue that I mentioned on earlier on in the futures markets, the curve structure. When you see the price decay from as you approach spot, the so-called contango effect that acts as a drag on performance. You don't get that on the physical market, and therefore you get better sources of return going to the physical market. And also, a lot of investors take greater comfort in something that's physically backed. So, our full suite of commodity physically backed products. There's actual gold sitting there in a vault. You go on our website, you can see the serial numbers of the bars that are held backing that, and that obviously provides a stronger credit protection for the end investor.
And following on from that, there's been a lot of discussion in the bullion market and the wider investment market about responsibly sourced gold. Um, what is responsibly sourced gold? Why is it an issue? And how do guys like investment managers, guys like yourselves, keep track of responsibly sourced gold or actually source it in the first place?
Yeah, so responsibly sourced gold is all about how has that gold come to being? What's the provenance of it? What's the environmental impact of the gold? And the gold market's probably slightly more advanced than most commodity markets in developing set of criteria for responsible sourcing. London Bullion Markets Association (LBMA), who I mentioned earlier on, the so-called gatekeepers for the institutional gold markets here in London, back in 2012, they started to define responsible source criteria. Now, the LBMA basically look after the refining community. And back in 2012, when they started these responsible sourcing criteria, their main focus was around anti-money laundering and know your customer criteria. But each iteration of their responsible criteria since then has been expanding on that and improving on the on that criteria. And um, when they put out their um, version 8 of their criteria back in 2018, which came into effect in 2019, they formally introduced ESG, environmental, social, and governance terms into their responsible sourcing guidance. And then since then, they've actually been expanding on that criteria even more. So back in the tail end of 2021, they introduced their version 9 of their criteria, which became effective in from January 2022. Um, the criteria just being incrementally improved over time. So we at WisdomTree, our entire gold range, physically backed gold range, is post 2020 um, and an increasing amount of our gold is post 2019. And we have products like our Wisdom Tree Core Gold, which is exclusively 100% backed by bars post 2022 even. So we're, that one product basically adheres to the criteria that has been sourced with the tightest responsibly sourced criteria. So, um, that's looking at this with the LBMA bullion markets. Um, there are some clients out there that want to see gold even that adhere to even greater standards than that, and that's one of the areas that we as Wisdom Tree will be looking at in terms of how do we provide gold solutions that can go even beyond the standard industry. Um, Standard. Um, there are some difficulties there, to move outside of the traditional benchmarks. You could be looking at gold that has lower liquidity potentially than the standard. And if one of the key things about the gold market is it's one of the most liquid commodity markets out there. If you do something that's slightly different, do you fragment that liquidity? Yeah, that's one of the things that we are trying to solve for right now.
And I wanted to just move on to silver, the other big precious metal that investors are interested in and following very keenly at the moment. Um, Looking at silver specifically, what are the main drivers of the silver price when you compared with gold? I mean, what makes it different in that respect?
Yeah, so silver and gold are tightly associated. And if you look at the correlation between the two metals, you've got a roughly 80% correlation in price behavior, looking at data going all the way back to 1990. Um, but as I describe gold as that pseudo currency, silver is probably a bit more like a regular commodity where supply and demand of physical units of silver actually matter for prices. And the way we look at demand for silver, well, more than 50% of end demand for silver goes into industrial applications. Things like electronics, photovoltaics, so solar panels. They're a couple of the key drivers of silver demand, uh, alongside photography and jewelry and um, silver plates and things like that. Um, the supply side for silver is also a little bit more complex than gold. Most gold is mined for um, directly for that gold, so you have specific gold mines. Whereas with silver, most of the silver supply that comes to market is a byproduct of mining for other metals like copper, nickel, zinc, for example. So 75% is basically byproduct. Only 25% of silver is mined directly for silver itself. Um, when um, when we think about price behavior of silver, we got alongside gold models that I mentioned earlier on, we also have silver models. The biggest input for our silver model is gold price, the gold price itself. But the way we judge demand for silver is to looking at um, indicators of industrial demand, and we use things like purchasing manager indices, manufacturing purchasing manager indices there. On the supply side, we look at the inventory of silver, looking at silver stocks on the futures exchanges, being one of the most timely indicators of silver demand there. But we also look at the capital expenditure that goes into mines globally across all metals. And the reason for that is, most of the silver comes as a byproduct of mining from the other metals. So we look at the mining industry in broad terms there. Um, so we have, alongside gold, we have a constructive view on silver, mainly because gold prices are rising. The silver may face a little bit of a headwind because industrial activity may cool on the back of all these central banks pressing on the brakes very hard and cooling to try to cool down their economies to reduce that sort of inflation risk. Um, but what we are seeing on the on the physical supply side is a lot of uh, silver supply deficits actually. So the demand for physical silver is outstripping the physical um, supply at the moment, and that means that we're eating above ground inventory at this point in time.
Gotcha. Yeah. So I was going to ask you about that because I talk to a lot of miners and silver analysts, and obviously you get these guys who are the perpetual silver bulls. They think silver is going to go to the moon. But one of the arguments we've had, one of them you've just touched on, is the fact that there is not enough silver being mined at the moment versus actual silver demand, particularly that industrial demand that you've spoken about. The other argument we hear a lot about, though, is the solar farm argument, because they're saying that, okay, you've got this situation, not enough silver's being mined. Part of that's because of the disruption from COVID, but on top of that, there's this massive global shift towards clean energy, and that requires the construction of acres and acres and acres of new solar farms. I've just been to Portugal and seen quite a lot of brand new solar farms stretching across the Algarve. So this is not an idle argument. Um, do you think that that shift to clean energy could actually have a new dynamic effect on the silver price? Is what they're saying got any real credence to it?
Yeah, so solar photovoltaics are probably one of the most um, strongest sources of growth for silver at this point in time. So yes, I think there is a lot of legs to that argument. This energy transition that we're in right now, the movement away from burning hydrocarbons and moving towards renewable sources of energy is happening at lightning pace. The Inflation Reduction Act in the US has really sort of changed the tone of things. Lots of countries had all these grand policy goals about climate change and decarbonizing, but had very few policies in place that helped actually meet that. But with the Inflation Reduction Act, that's changed the tone completely. And with the US having implemented the Inflation Reduction Act, and assuming you can actually get a budget for it, uh, the other regions like the European Union are going to have to come up with something that competes against that, because European Union was probably going to be one of the biggest losers of um, the IRA from the US. The IRA basically is trying to capture more of the value chain of that renewable transition, and take it away from China, because lots of the components of um, renewables is produced in China. Whether you look at the battery value chain or solar panels, etc. Um, are produced in China. As that moves more towards US, we're probably going to see some cost inflation going on. So that will probably be something that drives up silver prices in of its own. But as you get Europe and other nations actually trying to protect their markets, that's probably going to drive up the price of a lot of the raw materials that are needed for the energy transition, including silver. Um, on top of that, we are seeing we've visibly been seeing solar installations increase over the last few years. That process of thrifting of silver use in each individual panel has largely come run its course. So in previous years, we've been seeing each solar panel use slightly lower amounts of silver being one of the most expensive components that goes into these solar panels. But the technological ability to keep doing that has run its course. And in fact, the next generation of solar panels that are likely to see more growth in demand are actually looking like they're using higher solar loadings as well. Um, so I think the photovoltaic story is going to be very strong for silver. And just go back to your point on the supply demand equation, and that uh, silver deficits. Yeah, we're looking at silver deficits when we sort of exclude the sort of investment component from the from the equation. Uh, but it is clear that silver investors are quite bifurcated. So you've got the retail market where silver demand right now is extremely strong. Is extremely strong during 2022 as well. But the institutional market is typically the investors that go into exchange traded products like the ones we offer are somewhat muted. So the demand that was there from the retail dominated physical side had been sort of almost satisfied by the um, units that came out of the ETPs. Also, the deficits that are being driven by the high industrial demand is also being satisfied by the ETF market or the ETP market. Going into the latter half of this year, if we do start to see price rallies in driven by silver, we may see that reverse course as well, because some of the physical markets are that little bit more price sensitive. And if we do see a lot more demand coming from the institutional side, we may see that flow reverse course. So that's something maybe to watch out for.
Great. And just finally, you just mentioned there the fact that in the silver market there's a bit of a disconnect between the institutional appetite versus the retail appetite. I mean, that's obviously something that you guys at WisdomTree can see. What is it that why does that happen? Why do you get a situation where institutional investors and retail investors have completely different sentiment towards something like silver in the commodities market?
Yeah, I think the institutional markets tend to be somewhat distracted by other asset classes. Where when recently we've been seeing a bit of pickup in equity markets, and I think there's been more flow into some of the cyclical assets as a result of that, and less to the defensive markets like silver, and even gold hasn't seen a huge amount of ETP flow, despite the fact that prices have been quite strong. Um, Retail markets tend to be maybe that little bit more concerned about some geopolitical risks, with various election cycles. Debt ceiling concerns have also driven a little bit more flows into the defensive assets among the retail community. Hasn't really been picked up that much by the ETP market yet. Um, However, we are seeing, at least in the futures markets, a big pickup in sort of speculative interest on the futures markets, and it may be just a matter of time before ETP markets actually catch that bid as well. So um, that's something that maybe yet to come. But at the moment, I think the ETP market is slightly more focused on flowing back into some of the cyclical asset classes like equities, and we have seen a number of strong flows into other commodities at this point in time, and less sort of interest in gold. I think maybe as the risk becomes somewhat more heightened, in terms of, say, recession risk, or a slip up in, say, the debt negotiations, maybe that could drive a little bit more flow back into the defensives. But yeah, there has been that clear sort of demarcation between retail and institutional flows into gold and silver.
And very quickly, in the course of this discussion, we've talked about ETFs and ETPs. Can you just quickly say what the difference is between the two? Because I know we've used them interchangeably in the course of this discussion.
Yeah, so yeah, I mean, I would say the correct term to be using is exchange traded products, because the most of the physically backed gold and silver exchange traded products are not technically exchange traded funds. They're exchange traded debt instruments, because of their structure. Funds is usually used for the sort of equity structure, but that's a bit of a sort of technicalities, really. Exchange traded gold and silver is typically called exchange traded commodities, built as a sort of debt instrument. The umbrella term for all of these things, both funds and the exchange traded commodities, are exchange traded products. So that's kind of using the more generic term exchange traded products.
Fantastic. Thank you very much indeed, Nitesh. And thanks for coming on the show to talk about gold and silver today. We really appreciate it.
You're most welcome.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.